India is 110 consolidated financial statements. The objective of the Indian accounting standard is to establish principle of presenting and preparation of consolidated financial statement when entities control one or more entities. So when one or more entities been controlled by a single person, then what they need to give one statement. That statement states, so I'm holding this company. So my network is this much. Such a way I want to say. How can I say I have such a net worth? Only by consolidating all my holdings in that company. That company will have a balance sheet. I'm taking this much percentage of I having in this company. So my turnover, my net worth is this much percentage of their balance sheet. The consolidated financial statements or the financial statements are group of which the assets and liability, equity, income and expense, and cash flow of the parent and its subsidiaries are presented as those of the single economic entity. The same thing I said earlier. The standard requires entity that the parent is to present consolidated financial statement. Parent is to give the consolidated financial statement. The limited exemption is available to some entities. The standard defines the financial principle of control and establishes control as the basis of determining the entities as a consolidated in the consolidated financial statement. Okay. So this define based on the definition of control. It establishes control on the basis of determining entities as control. How is principle of control? How I have this much percentage of share. That is principle of control. Establishes control. What is established control? Now I have 14 director out of order. I control 8 directors. That is establishment of control. The investor controls the investee when the investor is exposed or his rights has a rights to variable return from its involvement in with his interestee and has ability to affect this return through his power over investee. So somehow I control them. Then I am the parent individual. Single control mode. Investor controls the investee if and only if the investor has all the following. He need to have three things. Three things. What are the three things? Power, exposure or rights to variable return from its involvement with the investee, and the ability to use power over the investee to affect the amount of investor return. So, what is the power over an investee? When the investor has existing rights that use its current ability to direct the in relevant activities, that is the activities that signifies the affect the investee's return. So I have something. So you have some return. Now I have this much control. So if I think so, you want to do this business, I can with my power can control your earning power. When I when I touch the earning, when I touch the return, I have the power to influence the return. That is power. Exposure or right to variable return from the involvement with investing. Investor is exposed or has a rights to variable return from the involvement with his investee when the investor return from the involvement has potential to vary result of investee performance. The investor returns can only be a positive and only negative or both positive and negative. So return can be positive dividend. Return can be negative capital erosion. It are both positive and negative. That is not zero. Return are broadly defined and include not only direct return but also indirect return. What kind of indirect return? Dividend is return. Indirect return salary. Indirect return I have some taken some asset from that company. Indirect return I can use some resources of that company. That is indirect return. The company will give loan for me interest free loan. That is indirect return. Ability to use control over the investor or affect the amount of investor return and investor control and investee if the investor is not only has a power over the investee and exposure or a right to variable return from the investment involvement in the investee price over right or rights variable returns but also have the ability to use the power to affect the investor's return from its involvement with investee. When they involve with the investee, they have a right, they have the power to influence the investment return. They can make an resolution not to do this business. They can make a resolution to do this business. They support the resolution. They can influence the resolution. That resolution, that is thing. An investor with an decision making right shall determine whether it is in principal or an agent. Power arises from rights. Sometimes assessee power is straightforward, and such as when the power is over an investee is obtained directly or solely from the voting rights granted by entities investment as a just share and can be assessed by considering the voting rights from those shareholders. In such, power has come from shareholders because this much shareholders, this much right, they can have this much 13% voting power, 14% voting power, 27% voting power, 90% voting power. In the case the investor consider potential voting rights that is substantive, right arising from the contractual arrangement or factor that can be indicate de facto power. Okay, on the other case, there the voting rights are not relevant for the assessing power. For example, when the power relay result from one or more contractual arrangement, assessment will be more complex and require more than one factor to consider such evidence of the practical ability to direct the relevant activities, a more important factor. The indication of the special relation from the investee, size of the investor exposed to variable return from the involvement of this investee. To have a power over investee, an investor must have existing rights that gives the current ability to direct the relevant activities. That is the activity that significantly affect the investee's return. Activity always the return is important. How this investor affect the return, affect the return, and has the right to affect the return, has the power to affect the return. How can he influence the return? That is solving. For the purpose of assessing the power over the substantive right and right that is not protective shall be considered. For the purpose of assessing the power, only substantive rights and rights are not protective shall be considered. The control is assessed in a continuous basis. Always the control is assessed in continuous, not a single basis. One power, how long, not a single day power. For a extensive period of 6 months, 12 months, 1 year, 2 years, that kind of control, continuous basis. The investment entity shall not be consolidated subsidiaries or apply Ind AS 103 when it obtain control for of another entity. Instead of investment entity shall measure its investment in subsidiary as a fair value through profit or loss in accordance with Ind AS 109. The parent of the investment entity shall consolidate all the entities in its control, including the control through an investment entity subsidiary, unless the parent itself is the investment entity. So the investment entity cannot consolidate its subsidiaries because they are investment entities. But the only the parent entity through the investment entity can take control unless the parent company is an investment entity. Okay. Accounting requirement, the consolidated financial statement, the combine the items like asset, liability, equity, income, expense, and cash flow of the parent of though with those of its subsidiary. For the subsidiaries, their income, expense, balance sheet, income, cash flow, everything to be added. Offset, eliminate the carrying amount of the parent investment in each subsidiaries and parent portion of equity of each subsidiaries. India is 103 explain how to account for related goodwill. So when we have our investment is their equity, right? So that need to be removed. Eliminate the full intergroup assets and liabilities. Eliminate the equity, income, expense, and cash flow relating to transaction between entity and groups. There are intergroup transaction, intergroup purchase, intergroup stock options, intergroup investments that will be removed. Profit and loss resulting from the intergroup transaction that are recognized in assets such inventory and fixed assets are eliminated in full. The parent shall prepare consolidated financial statement using uniform accounting policy or like transaction and other events in similar conditions. Difference between the reporting date of a parent and subsidiary should not be more than 3 months. So, not be more than the difference between the reporting date of parent and its subsidiary shall not be more than 3 months. Reporting period like 3 months. Within 3 months, you should do. Adjustments are made the effect of significant transaction and events between two dates. Mm. The consolidation of investee shall begin from the date of investor obtains the control of the investee and ceases when the investor loses the control of investee. So within the year, they have 7 years, 7 months control. So in that case, In 31st March, they don't have the control, but in December they has a control. So the interim report consolidated financial will be there. But in the case of 31st March, there will be no control. There we won't show the consolidated financial statement of that entity which we sold off. Non-controlling interest, the equity in a subsidiary not attributable directly, indirectly to parent. What they are saying, to the extent of non-controlling interest relating to the present ownership are interested that entitle their holders to appropriate share of equity net asset in liquidation. These are measured at fair value or the portion proportionate interest in the net asset of acquiring the date of acquisition. All other NC are generally measured in fair value. Always the holding should be sold in fair value. I invested in some amount, but the investment has acquired to fair value. Means like you should not say I invested for 10,000 rupees. Now I will account for 10,000 rupees. No, when I made a 10,000 rupees, the current market value of the business. What is it? If not, what is the book value of the business? That is a fair value. And the parent shall present non-controlling interest in consolidated balance sheet with equity separately from the equity of owners of the parents. The changes in the parent ownership interest is a subsidiary that do not sell the parent losing control of subsidiary or equity transaction, that is transaction with the owners in the capacity as owners. A change in parent ownership interest in subsidiary that do not result in parent losing the control of subsidiary or equity transaction, that is a transaction with the owner is the capacity as a owner. Hmm. Loss of control. If the parent loses control of subsidiary, the parent should de-recognize assets and liability of the former subsidiary from the consolidated financial statement. When they sell their investment, they should not recognize them as like in the consolidated financial statement. Recognize any investment retained in the former subsidiary as a fair value and control is lost subsequently the account of it and for any amount owned by or to the former subsidiaries in accordance with the relevant NDAs. So fair value we will keep, but when the control is not need to go through the NDAs for valuation because there will be no valuation sometimes. The fair value shall be regarded as a fair value of initial recognition of financial asset in accordance with NDAs 109 or appropriate because in initial recognition of investment in an associated joint venture. Recognize gain or loss associated with the loss of control attribute to the formal controlling interest.